Well, hello and welcome to this special broadcast where Nigeria's Central Bank Governor Godwin Emefiele will outline the position of Nigeria's Monetary Policy Committee in its fourth meeting of the year. Looking at global developments, the IMF expects global interest rates to keep rising until 2023 as central banks take the global inflation challenge head-on. The U.S. Federal Reserve has also signaled the possibility of raising interest rates by 0.75% later this month for its second straight meeting. In May, Nigeria's Monetary Policy Committee unanimously voted to raise the monetary policy rate by 150 basis points. We understand that the central bank governor is already seated and, of course, has kicked off the meeting. So we're just going to take you right to the Monetary Policy Committee meeting.
Global trade and growing risks to financial stability associated with the burgeoning global private and public debt profile. 11 members of the committee attended this meeting. Global economic developments. The committee noted with concern the downtrend in global recovery aggravated by supply chain disruptions as a result of Russia-Ukraine conflict and the spillbacks and spillovers from sanctions imposed on Russia by the US and its allies. This has resulted in an unprecedented rise and widespread global inflation, which is exacerbating downward pressure on the fragile recovery of the global economy. In addition, lingering headwinds associated with COVID-19 pandemic are constraining the smooth functioning of the global supply chain. The rising risk of tightening global financial conditions implies that developing economies now face the risk of constrained access to global capital, which would further depress growth in this group of economies. This is expected to result in increased financial vulnerabilities due to the huge volume of corporate and public debt accumulated in the wake of the sharp downward downturn driven by COVID-19 lockdowns. In the light of these developments, the key risk confronting the global economy is that of a recession, which may crystallize as second quarter growth figures for major advanced and developing economies begin to emerge. Consequently, the IMF in its April 2022 World Economic Outlook wheel downgraded its global output growth forecast for 2022 and 2023 to 3.6% apiece from 4.4% and 3.8% respectively, with the likelihood of a further downgrade given the continued deterioration in output. Inflation in several advanced economies pushed further higher and further away from the long-run objectives of their central banks, reflecting the sustained increase in the price of food, energy, and other commodities due to the harsh combination of persistent supply chain disruptions and pent-up demand. In the emerging markets and developing economies, inflation is also on the rise, compounded by legacy structural challenges as well as heightened exchange rate pressures driven by rising capital flow reversals, in addition to the outlined shocks from the global economy. In the financial markets, available data suggests that investors are now rebalancing their portfolios away from gold and equities to fixed income securities to take advantage of rising yields in the advanced economies as major central banks progress with interest rates. Consequently, the tightening of global financial conditions is expected to heighten investments and debt default risks, leading to likelihood of a broad economic slowdown. Domestic economic development. According to National Bureau of Statistics, NBS, real gross domestic product GDP grew by 3.11% year-on-year in the first quarter of 2022, compared with 3.98% in the fourth quarter of 2021 and 0.51% in the corresponding period of 2021. The economy has thus grown for 6 consecutive quarters following its exit from recession in 2020. This consistent positive performance was driven largely by the continuous growth in the non-oil sector, specifically in the services and agriculture subsectors, ongoing policy support post-COVID lockdowns, and the base effect from the corresponding period. Staff projections show that the economy is expected to remain on a path of sustained positive growth observed in the last few quarters. The committee also noted that both the manufacturing and non-manufacturing purchasing managers indices increased above the 50 index point benchmark to 51.1 and 50.3 index points in June 2022, compared with 48.9 and 49.9 index points respectively in May 2022. This reflects the continued rebound in economic activities due to improvements in supplier delivery times, raw materials inventory, and employment levels, as well as expansion in some sectors such as agriculture, accommodation, electricity, among others. Committee noted with concern the persistent uptick in headline inflation year-on-year to 18.6% in June 2022 from 17.71% in May 2022, and 89 basis points increase in just a month. This continued increase in inflation was driven by increases in both the core and the food components to 15.75 and 20.6% in June 2022. This considerable rise in core inflation resulted largely from the rising cost of production due to high energy prices associated with the persistent disruptions to power supply, hike in electricity tariff, continued scarcity of petroleum motor spirit PMS, and rising price of automatic gas oil AGO. The increase in the food component was, however, driven by shocks to food prices associated with continued insecurity in food producing areas and along major access routes across the country, the continued impact of the war in Ukraine on the supply of fertilizer inputs, wheat and other grains, exchange rate pressures, and the impact of monetary policy normalization on capital flows away from emerging markets. The committee, however, expressed confidence in the bank's sustained intervention programs, noting that inflation is expected to abate as food supply improves and the fiscal authorities sustain its efforts to tame the legacy structural challenges which put upward pressure on domestic price levels. Members therefore urge the fiscal authority to expand and sustain its support for all this recently deployed stimulus to the real sector of our economy. The Monetary Policy Committee noted that broad money supply M3 rose significantly to 11.52% in June 2022, compared with 10.86% in May 2022. This was largely driven by the growth in net domestic assets NDA of 18.02% in June 2022, compared with 17.37% in the previous month. The sustained growth in net domestic assets was attributed to the increase in claims on the federal government and other sectors, in this case public, non-financial corporations, private sector, and state and local governments. Money market rates oscillated above and below the asymmetric corridor, reflecting prevailing liquidity conditions in the banking system. Consequently, the monthly weighted average open buyback rate OBB and interbank call rates increased in June 2022 to 10.89 and 11.1% from 9.39 and 8.38% in May 20, respectively. The increase in both the open buyback and interbank call rates reflected the tight liquidity conditions in the banking system. Capital adequacy ratio and the liquidity ratios both remained above the prudential limits of 14.1 and 42.6% respectively in June 2022. Committee, however, noted with concern the slight uptick in non-performing loans ratio of 5% in June 2022 compared with 5.7% in June 2021. The MPC thus urged the bank to sustain its tight prudential regime to ensure that NPL ratio is brought well below its prudential benchmark. MPC noted the very moderate decline in the performance of the equities market in the review period, as the all-share index and the market capitalization moderated to 51,817.59 and 27.94 trillion naira on June 30th, 2022, from 52,990.78 and 28.56 trillion naira on May 31st, 2022, respectively. The market, however, remains resilient, reflecting continued confidence in the Nigerian economy as both the monetary and fiscal authorities work assiduously to improve macroeconomic fundamentals in Nigeria. Committee noted the marginal increase of 1.61% in the level of external reserves to $39.22 billion at the end of June 2022, from $38.360 billion at the end of May 2022, due to increase in flows from non-oil sources. The committee reviewed the performance of the bank's intervention programs targeted at stimulating productivity in agriculture, manufacturing industries, energy and infrastructure, healthcare, exports, and micro, small, and medium enterprises between May and June 2022. Under the Anchor Borrowers Program, for instance, the bank released the sum of $3.62 billion as disbursements to 12 projects for the cultivation of rice, wheat, and maize, bringing in cumulative disbursements under the program to 1.01 trillion naira to over 4.21 million smallholder farmers cultivating 21 commodities across the country. The bank also disbursed $3.72 billion to finance 3 large-scale agricultural projects under the Commercial Agricultural Credit Scheme. These disbursements bring the cumulative disbursement under this scheme to 744.32 billion naira for 678 projects in agro production and agro processing. As part of its efforts to support the manufacturing sector, the CBN disbursed the sum of 113.08 billion naira to 19 new projects under the Real Sector Facility. The funds were utilized for both greenfield and brownfield projects under the COVID-19 intervention for the manufacturing sector and the Real Sector Support Facility from differentiated CRR DCRR. Cumulative disbursement under the Real Sector Facility currently stands at 2.183 trillion naira for the financing of 414 real sector projects across the country. Furthermore, under the 100 for 100 policy on production and productivity, the bank has released 9.98 billion naira to 5 projects, bringing the cumulative disbursements under the intervention to 68.13 billion naira to 48 projects comprising 26 in manufacturing, 17 in agriculture, 3 in healthcare, and 2 in the services sector. Under the healthcare sector, the bank disbursed 4.44 billion naira to 3 healthcare projects under the Healthcare Sector Intervention Facility, bringing cumulative disbursements to the healthcare sector to 133.42 billion for 129 projects comprising 76 hospitals, 32 pharmaceuticals, and 21 other healthcare services. To further expand the nation's non-oil export basket under the Export Facilitation Initiative, the bank released the sum of 36 billion naira for 5 projects in domestic production and value addition of cocoa, sesame seeds towards improving non-oil foreign currency revenues. To improve electricity supply, in order to lower the overall cost of production in the real sector, the bank also intervened in the power sector to facilitate deployment of enabling infrastructure. Summarily, the sum of 2.53 billion naira was disbursed to DISCOs for the operational expenditure, OPEX, and CAPEX under the Nigerian Electricity Market Stabilization Facility, Phase 2. Cumulative disbursement under the NEMS 2 currently stand at 254.46 billion naira, 6.4 billion naira. Under the National Mass Metering Program, the bank disbursed 47.82 billion naira for the procurement and installation of 865,956 meters across the country. The outlook. The broad outlook for both the global and domestic economies in medium term remain clouded with uncertainties associated with winds such as the substantial disruptions to supply chain, the Russian-Ukraine war, and the lingering impact of COVID-19 pandemic. Others include the rising level of corporate and public debt in the advanced economies and emerging market and developing economies, as well as the broad shocks to foreign capital flows driven by the aggressive normalization of monetary policy in some of the advanced economies. On the domestic front, available data on key macroeconomic variables indicate the likelihood of a subdued output growth for the Nigerian economy in 2022. This is hinged on the ongoing and expected shocks from the global economy, particularly from supply blockages of essential exports from both Russia and Ukraine, the impact of high crude oil prices given Nigeria's position as an oil exporter and importer of refined petroleum products, and the aggressive normalization by some advanced economies. Accordingly, the Nigerian economy is forecast to grow in 2022 by 3.3% CBN estimate, 4.2% federal government estimate, and 3.4% IMF estimate. The committee's consideration. Committee assessed the impact of emerging external shocks and legacy issues on price development and the recovery of output growth in the short to medium term. Members further noted the continued effort by both the monetary and fiscal authorities to dampen price pressures and sustain the recovery of output growth. In the opinion of our members, the major external shocks to the economy remained those associated with supply constraints arising from the Russia-Ukraine war and backlash from sanctions imposed on Russia, residual impact of COVID-19 pandemic, and tightening external financial conditions, particularly global financial markets, following the aggressive normalization of monetary policy by some advanced economy central banks. On the domestic scene, members assess the impact of the continued upsurge in money supply resulting from the increased demand for money associated with election spending, an increase in month-on-month inflation between May and June 2022. In addition, the committee assessed the continued impact of rising insecurity, the rising cost of automatic gas oil AGO, and the persistent upward pressure on other energy prices on the general price level. MPC noted that the current upsurge in price levels remain a primary concern to monetary policy, as members focus on the optimal policy approach required to address this development while protecting our fragile economy. The committee clearly identified that inflationary pressure was being driven by both demand and supply side factors, which should be addressed using different policy approaches. In the committee's view, the demand side factors were being broadly addressed by the bank using the relevant direct and indirect instruments. On the supply side, the bank has continued to provide the necessary support through its development finance initiatives in the real sector to ease supply constraints. Committee called on the federal government to prioritize efforts to curb the menace of insecurity to enable farming and other business activities return to normalcy. The MPC thus called on the bank to continue its investments towards increasing food supply in a bid to addressing food inflation. Members also noted the upward price pressure, particularly on transportation, resulting from the prolonged scarcity of premium motor spirit PMS, and called on the federal government to seek a long-term and viable solution to strike a balance between the pricing and supply of PMS in Nigeria. Committee appraised the continued recovery of output growth, noting that despite the obvious external and internal headwinds, the recovery has remained resilient with hopes of a stronger medium-term recovery. This is, however, hinged on the continued support by the bank and the federal government to ensure that recent economic gains are indeed sustained. MPC welcomed the bank's concerted efforts towards ensuring exchange rate stability, noting the current difficulties associated with managing the stream of external shocks impacting the economy. Committee applauded the performance of the RT200 and similar initiatives targeted at improving accretion to reserves and stabilizing the exchange rate. The MPC noted that foreign exchange inflow through the RT200 FX program during the first quarter and the second quarter of 2022 had increased substantially to almost $3 billion as of June 2022. Members also noted the increase in diaspora remittances as a result of the Naira for dollar incentive and urged the bank not to relent in its efforts to encourage foreign exchange inflow into the country. Committee noted the federal government's increasing debt profile and expressed concerns over debt sustainability given that global uncertainties remain elevated. MPC thus reiterated its call to the federal government to urgently diversify its revenue sources through various initiatives such as the development of a viable tax framework for the extractive and mineral export industries to strengthen its fiscal buffers. Despite the apparent headwinds confronting the economy, the MPC noted that the banking system remained robust given the continued decline in NPLs below the prudential threshold and enjoined the bank to sustain the trend by maintaining its vigorous surveillance to ensure continued resilience of the banking system. The committee's decision. MPC noted with concern the continued aggressive movement in inflation even after the rate hike at its last meeting and expressed its unrelenting resolve to restore price stability while providing the necessary support to strengthen our fragile economy. As regards the decision as to whether to tighten, loosen, or hold, members were unanimous and so did not consider both loosening and retaining rates at existing levels at this meeting. This is because on loosening, the MPC felt loosening will worsen the existing liquidity condition in the economy and further dampen money market rates necessary to stimulate savings and investments. Members also felt that loosening would trigger the weakening of the exchange rate, which could pass through to domestic prices. MPC did not also consider holding rates constant because a hold stance may suggest that the bank is not responding sufficiently to both the global and domestic price developments as inflation numbers continued to trend aggressively upwards. And as regards tightening policy stance, members were unanimous that given the aggressive increase in inflation, coupled with the resultant negative consequences, particularly on purchasing power of the poor, as well as retarding growth, there is the need to continue to tighten. However, the policy dilemma was hinged around the level of tightening needed to rein in inflation without dampening manufacturing output, which could result from the higher cost of borrowing. Aside from narrowing the negative real interest rate gap, members were also of the view that tightening will signal a strong determination of the bank to aggressively address its price stability mandate and portray the MPC's sensitivity to the impact of inflation on the vulnerable households and the need to improve their disposable income. Members also noted that the last 150 basis points hike by the committee in May had not permitted enough in the economy to halt the rising trend in inflation and noted that the month-on-month percentage point increase in headline inflation rose sharply in June 2022 compared with May 2022. MPC also noted that other complementary administrative measures deployed by the bank to address the growth in money supply did not moderate the inflationary trend. Addressing the balance of policy objectives and developments in the global and domestic environment, the committee resolved that the most rational policy option will be to further strengthen its tightening stance in order to effectively curtail the unabated rising trend of inflation. Members were conscious of the fact that output growth remained fragile. However, not containing inflation now could erode the moderate gains achieved, improving consumer purchasing power, and thus worsen poverty levels for the vulnerable populace. To ensure that output still remains in focus, MPC advised the bank's management to continue to use the development finance tools to support the agricultural and manufacturing sectors in Nigeria. Committee thus voted unanimously to raise the monetary policy rate, MPR. One member voted to increase the MPR by 150 basis points, 6 members by 100 basis points, 1 member by 75 basis points, and 3 members by 50 basis points. Consequently, committee resolved to increase the MPR by 100 basis points from 13% to 14%. And in summary, MPC voted as follows. 1. Increase MPR to 14% from 13. 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5%. And 4. Retain liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor.
Well, there you have it, the outcome of the MPC meeting. The members unanimously voted to raise the MPR, that's the monetary policy rate, by 100 basis points to 14%. We'll take a quick break, and when we come back, we'll take you straight into our post-MPC analysis. Join us again.